Good evening, everyone. On behalf of L&T Management, let me welcome you all for the media briefing of our financial results for Q3 FY20. As always, we will have a presentation on the financial performance of the company by L&T's whole-time director and CFO, Mr. R. Shankar Raman, followed by Q&A addressed by Mr. Raman and L&T CEO and MD, Mr. S.N. Subramanian. Now let me request Mr. Raman to begin his presentation.
Good evening, everybody. Thank you for being here this evening. Happy to report to you the Q3 results of the company with the usual disclaimer that any forward-looking statements need to be seen in the context of today's conversation, and it could change going forward. Before I get into the performance highlights, I think a few broad comments. The satisfactory results that we are going to share with you has been outcome of a lot of hard work by my colleagues in the company, and it's been a very challenging quarter. In fact, it has been a very challenging 9-month so far in the year, and so the results that are presented are to be seen in the context of the business climate in which we are required to deliver and create value. It is credible that the company has been able to muster its strengths and exploit its potential fully to be able to deal with what the economic challenges the company is up against. It's well known now and well commented and maybe even well accepted that the economic growth has slowed down considerably. We're talking about sub 5% as per the current assessment. And that's not really good news for companies like us, which depends on investment and investment momentum. But having said that, the good part of the situation is the opportunities have not disappeared. The prospect and the potential that the company is looking at continues to stay very encouraging. There have been deferments and there have been postponements of projects and programs. And the way we are looking at it is that these are opportunities deferred and not opportunities lost. Having said that, just a snapshot of how the company has fared in Q3 as of 31st December 2019. The order inflow as compared to the Q3 of the previous year is up by 2%, much against the market expectation where we were expected to report a decline. And to the credit again of our business leaders that we have been able to garner much of the targeted orders sans deferments. The order book consequently has grown by 9%. Revenue is up at 6%. You will recall at the half year level the revenue was up by 12%. It's at 6% for this quarter. EBITDA is up by 10%. That's good news because as we deal with little softish revenue, we have dealt with more profitable revenues. So the margins are up by 10%. And the profit after tax is up by 15%. And these are quarterly numbers compared to the Q3 of the previous year. Starting with the order inflow, we picked up orders worth 416 billion rupees against fairly stiff competition because opportunities being limited, competition tends to get tough. It's a 2% growth, as I mentioned, over the Q3 of the previous year. Out of the 416 billion rupees, 237 billion rupees comes from the domestic markets and 179 billion rupees comes from international market. The domestic market, as we can make out from the corresponding numbers of Q3 of the previous year, is down by 20% as compared to the reference period, whereas the international markets have yielded better results, and we've been able to establish a growth of nearly 70% by taking up the international orders to 179 billion rupees from 109 billion rupees. So there has been a bit of a compensating effect here, but this also plays true to the strategy of the company to straddle the opportunities both in the domestic market and international market so that we can balance them out appropriately without upsetting the overall growth momentum. As far as the 9-month is concerned, I think we are well in track. We had given a guidance of 10 to 12% order intake for the year FY20. At 9-month level, we are up 11% because we had a good start for the year. We were up almost 15% at the half year level. So even providing for the soft Q3, we are up 11%. And that gives us the confidence that we should be able to target and work towards a 10 to 12% order intake band that we had guided the market early this year. Statistically speaking, the domestic orders account for 850 billion rupees and international orders account for 436 billion rupees, and making a total of 1.2 trillion rupees of fresh orders for 9 months so far in the year. The mix of international orders is roughly around 34% to the total orders. When it comes to order book, we have a cross 3 lakh crore. We are at 3.06 trillion rupees, up by 9% as compared to 2.8 trillion of December 19 a year ago. The mix, thanks to the surge in international orders during the year, has gone better in favor of the international orders. So we have 24% of our order book from international markets and 76% from domestic markets, as compared to 21% in December 19. As I mentioned to you, while the mix between international and domestic have been fluctuating, it's very important to appreciate that the prospects that we are searching and working on to win our orders continue to be 5 or 6 times the numbers that we actually report as our win. So the win ratio continues to be around 15% of the orders that we pursue. For a 9-month period, bulk of the orders that we have won, which is 1.28 trillion rupees, comes from infrastructure sector. Virtually almost half of that is from infrastructure sector, and hence we keep laboring on this point that health of infrastructure investment, both in the country and outside of the country, is important for our group to get commissioned in all these projects. Hydrocarbon has been growing well over the last 6 or 8 quarters, and that is reflected by increasing share of hydrocarbon at about 15% for the 9-month period. Since for statistic reasons we include all the businesses that we run as a group, the services are also added here. The revenues of services actually translate into orders for services business, and they account for about 23%. The order book of 3 trillion rupees, 3.06 trillion rupees, actually has 2.2 trillion from infrastructure segments. This includes both domestic and international, and roughly about 74% of the total order book. Hydrocarbon at 464 billion has again a large share of orders to be executed, followed by power, which has 164 billion rupees. Early on this year, we won an EPC order for power, and we've been winning some orders for the FGD, flue gas desulfurizer projects. So the power order book has improved in the 9-month period to about 164 billion rupees. It is heartening to note that each of the sub-verticals, the major ones at least, are all blessed with 450, 460 billion dollars or billion rupees worth of orders. So that provides certainty about revenue visibility for the next 2.5 years. On the performance, the revenue of the group for the 9-month period ended 31st December 2019 is 1.01 trillion rupees, and for the quarter it's 362 billion rupees. The revenue is up by 10% for the 9-month period and 6% for the quarter, as we had seen earlier. 36% of the quarterly revenue and 34% of the 9-month revenue are on account of contracts that we execute internationally and the goods and services that we export. The manufacturing and operating costs declined by 3% for the quarter 3 at 218 billion rupees and up by 4% for the 9-month period at 606 billion rupees. The interest cost incurred by the financial services company is treated as an OPEX, and they account for 20 billion rupees in our quarterly charts, up 1%, and at 61 billion rupees, up 13% for the 9-month period. Staff cost is up 38% at 61 billion rupees for the quarter and 30% for the 9-month period at 168 billion rupees. It's important to note here that from the quarter 3, we have Mindtree staff cost getting added. So about 12 billion rupees of the 61 billion rupees is on account of Mindtree. And for the 9-month period, it's about 25 billion rupees. So if I exclude the Mindtree addition into this, the normal increase in staff cost of the rest of the L&T group is about 10%. The sales and administration cost of the group is at 21.4 billion rupees for the quarter 3, which is up 40%. and at 64 billion rupees, up 22%. The provisioning that we have made for the financial services business, as well as the expenditure that we have incurred on acquisition, have all contributed to the rise in this period under question. The total operating expenditure up 10% for the 9-month period and 5% for the 3-month period. Consequently, the EBITDA at 41 billion rupees for the 3-month period and 112 billion rupees for the 9-month period is up 10% and 12% respectively. And this is where I find the comment of margin increase getting expressed from 11% to 11.4% for the quarter and from 10.9% to 11.1% for the 9-month period. You will recall in the earlier commentaries that we've had that we liquidated our temporary surplus investments to be able to finance the acquisition of Mindtree. So consequently, the treasury balances that we have at hand to be invested in the market is far lower in Q3 as compared to the previous year. So we find there is a decline in other income at 4.7 billion rupees for the Q3 and at 17.1 billion rupees for the 9-month, shows a contrary direction, largely because of the gains that we have booked when we liquidated the investment for the purpose of acquisition. Interest cost at 7.1 billion rupees for Q3 and 19.8 billion rupees for the 9-month period show an increase of 33% and 53%. It is to be borne in mind that as we have increased the borrowing during the course of the 9-month, year to year, it's almost 13,000 crores. The interest cost on account of that additional borrowing is embedded in the increase in the interest cost, as well as the fact that Hyderabad Metro has been commissioned substantially, about 10 kilometers short of the overall stretch of 66 kilometers has been commissioned. And as we commission the project, the capitalization comes to an end and the interest cost gets charged to the P&L. So there is an element of interest cost increase of Hyderabad Metro as well. Plus the new accounting standards on leases compels us to segregate the lease rental income into principal returned as well as interest paid. So the principal return gets, the interest paid gets added to the interest cost as well. So in a way, it's not a very straightforward comparison of two periods. It's a combination of several moving parts insofar as fund management is concerned. Depreciation amortization at 6.6 billion rupees for Q3 and 17.5 billion rupees for 9-month period show an increase. Here again, I think the accounting standards on lease accounting plays a role, plus the fact that we are now integrating Mindtree charts into our charts. So there is an increase on account of depreciation of that acquisition as well. Exceptional income, we have nothing in the current year. There is no impact on the financials of the company. The discontinued operations are the electrical business that we have held for sale, and the process is underway. And the business, however, has done well, and according to the accounting conventions, we only report the net results of the business, electrical business. The quarterly profits are 1.9 billion rupees, up 36% as compared to Q3 of the previous year, and at 5.2 billion, up 41% as compared to 9-month period. The profit after tax, considering all of this for the Q3, is at 23.5 billion rupees, up 15%. And for the 9-month period at 63 billion rupees is up 16%. The segments that we are engaged in, which has generated these returns, is what we will go into at the moment. The infrastructure segment, the revenues have degrown by 5.3%. And here I must mention that while the order intake of the infrastructure segment for Q3 has moved up by 28%, there have been considerable challenges on execution front, particularly in this quarter. It's well publicized once again that change of governments have led to stoppages of work. We've had public interest litigations which came in the way of project execution, and above all we had pollution factors which prevented construction sites to work. A combination of all of these things upset our revenue growth plans, and the good part of this is I think most of these are hopefully getting behind us, and we will find us getting back to more acceptable trajectory going forward in the subsequent quarters. But be that as it may, the Q3 does show a revenue decline for infrastructure segment at 5%. However, for the 9-month period, since we had relatively uninterrupted situation in the first 6 months of the year, we are grown infrastructure segment revenue by 4.7% at 477 billion rupees. The EBITDA margin of the segment has improved well, even though the revenues had declined for Q3, the margins have moved up by 70 basis points. This is largely representing the stage of execution of the infrastructure projects that are coming up for valuation. The EBITDA margin for the 9-month period at 6.5% is up 30 basis points as compared to the 9-month period of the previous year. Power segment continues to have mixed fortune. We've had a good start to the year, won some EPC contracts. We continue to win some FGD contracts, but large EPC contracts are elusive because of the deferment of those projects. So consequently, the opening order book, which was very soft because of the lack of orders in the previous year, continued to have impact on the revenue of the current year, and the revenue declined by 23.4% in Q3 and 42% in 9-month period. Now, this trajectory can be reversed only when we build our order book through fresh order wins. Otherwise, as we execute the projects that we are bagged, the revenues will only tend to come down going forward. But we do believe that with some order wins in the current year and hopefully some more along the way, we should be able to get the revenue into more healthier levels. The EBITDA margin of this segment is about 3.4% for the Q3 and 3.6% for the 9-month period. It's important to recall here that the manufacturing joint ventures that we have, being jointly controlled with our partners, are not consolidated at EBITDA level, they are consolidated at PAT level. So the EBITDA margins of the manufacturing activities are far healthier than the pure EPC, which is at 3.4 and 3.6% respectively. Heavy engineering segment had a good run in the previous year in terms of order intake. So consequently, they are having a good run this year in terms of revenue. The quarterly revenue at 7.2 billion rupees is up 19.6%, and at 22 billion rupees is up 57% as compared to the previous year. Much of this business is international, as you can make out that out of the 7.2 billion rupees, 4.1 billion rupees is from international orders. And likewise, nearly 50% of the 9-month revenue is also from international orders. The margins in these businesses are good as we complete the jobs and deliver to the customer's requirements. The margins for the quarter is at 23.5%. And for the 9-month period is 22.3%. The margins again is a mix of the delivery schedule and the stage of execution. So consequently, while the quarter-to-quarter trajectories could be misleading, it's important to understand that this is one of the superior margin business for the simple reason that the technological differentiation and the track record that we have with international customers is far superior to the nearest competition that we have from India. Defense engineering segment, the revenue has grown by 5.8%. These are arising out of execution of the order book that we already have, thanks to the order wins of the previous year. And for the 9-month period, the revenues are 30 billion rupees, up by 14.4%. Much of this revenue is domestic, as we can make out from the nature of the orders that we have received. And the EBITDA margins, like the heavy engineering, is pretty healthy at 20.5% for Q3 and 18.4% for the 9-month period. Hydrocarbon segment continues to do well. For the last 8 quarters, the business has been reporting quarter-on-quarter improvement in terms of operational parameters, execution capabilities, as well as ability to win orders. The segment revenue for Q3 at 43.9 billion rupees is up 16.6%, and for 9 months at 124 billion rupees is up 15%. Much of the revenues come from international business. Nearly 45 to 50% of the orders that we win are in the international markets. So the international revenues continue to be a fairly significant percentage of the total revenue. The EBITDA margins have been improving as the execution efficiencies have improved, as we adopt more and more into digital technologies for productivity and enhancement, as well as smartening the procurement and engineering processes. We are able to get ahead of the budgeted levels for margins. We are at 12.1% at Q3 level and at 10.9% at the 9-month level. The sustainability of these margins, we do believe, is there. Of course, it all subject to the execution track record that we have on the order book, and it is project to project. It's living life project to project. The current set of projects are well administered and well delivered. Information technology and technology services, you would have had an opportunity to see all the results. All the three companies, L&T, Infotech, Technology Services, as well as Mindtree, have announced their results, and you would have seen that all of them have reported encouraging numbers. The consolidated segment revenue for this segment is 60 billion rupees for Q3 and 157 billion rupees for 9-month period, showing an increase of 64% for Q3 and 48% for 9-month period. The percentages are inflated largely because the previous year's numbers exclude Mindtree and the current year numbers includes Mindtree. But suffice to know that on an aggregated basis, the revenue growth year on year for each of these companies are in the ballpark range of 10 to 12%. Much of this business is international, as you know, and the EBITDA margins at 21% for Q3 and the same percent for the 9-month period does show a decline as compared to the position previous year. Largely because of two reasons. One is, I think, the staffing costs and the resourcing costs have been going up steadily as we increase the international content of our workforce. And secondly, when you integrate Mindtree, the profitability of Mindtree are not in par with the LTI as well as L&T Technology Services. So until they improve, for which we have a roadmap, there's going to be a blended decline in the margins reported. We do think that in the next 2 to 3 quarters, this position should dramatically change. Financial services segment, once again I have reported their revenues a few days ago. The revenue for the Q3 is at 35 billion rupees, up 8.9%. This is despite a 20% decline in the disbursement. The business, for very obvious reasons, have got fairly conservative when it comes to disbursement decisions and credit calls. The environment does not support aggressive lending. So consequently, the revenue growth, which used to be in double digits, have come into single digits, but I think it's a tactic par for the course considering the current conditions. For the 9-month period at 104 billion rupees, it is just about meeting the double digit at 10.6%. And the profit after tax belonging to L&T, net of the minority interest holders, is at 3.8 billion rupees for quarter and 8.4 billion rupees for the 9-month period. You see the decline in the profitability largely because of the provisioning that is required to be made for the non-performing asset. The net non-performing asset of the business is about 2.7%, with considerable provisioning having been made for the assets which are worthy of those provisioning. Getting on to developmental projects, it's a combination of the Nabha Power thermal power plant that we run in Punjab and the Hyderabad Metro. The revenues are largely from the thermal power plant business because Hyderabad Metro is yet to contribute significantly to the revenue asset. 12.4 billion rupees for Q3, the revenue is up 3.7%, and at 38.7 billion rupees for 9-month, revenue is down by 2.9%. The margins at 17.3% for Q3 and 12.4% for the 9-month are reflective of the margins that the power business and the Hyderabad Metro business has, because in all these concessions, as you know, EBITDA margins are high. It is the interest and depreciation that actually trends the PAT down. In other segment, which consists of our construction mining equipment business, rubber processing machines, valves, as well as reality, the revenue at 12.5 billion rupees is down 22%, largely on account of the lumpy commercial property sale that we did in the previous year, Q3, out of the realty business portfolio. And for the 9-month period at 39.4 billion rupees is again down 10.2%, largely because of the same reason. The EBITDA margins at 21.9% for the Q3 and 22.5% for the 9-month period continues to be healthy, although reflecting a decline, which is largely on account of the slowdown in industrial demand as well as the softness that we see in the real estate sector. Electrical and automation segment, the final segment which we are holding it for sale, has shown a decline in revenue at Q3 at 13.3 billion rupees and a marginal decline of 1.1% for the 9-month period at 41 billion rupees. It's important to note that the industry has declined by a much larger percentage, reflecting the slowdown all around, and the fact that our business has declined lesser means that our market share in the relatively challenging conditions have improved. The EBITDA margins of the business continues to be very healthy at 19.3% for Q3 and 18.1% for the 9-month period, validating the several initiatives that the business has taken to make the business more profitable. So with this, we conclude the presentation and happy to take questions and answers. Thank you.
Hi guys, good evening. Nobody says good evening.
Studied silence.
So we will ask you questions this time, you people reply.
Hi, Archana from CNBC.
Yes,
I just
Archana.
want some more clarity and more color on the infrastructure business and how is the order inflow panning out in quarter four? What is your expectation for the next quarter when the infrastructure order book is concerned? And also on the working capital, what is the situation right now?
You asked, I think 3-in-1 questions, but you'll try to be this and that. As you could see, up to 9 months, we have managed, in the 9 months, I think we have managed a growth, and that includes the infrastructure business. The orders are there, but they're taking slightly more time to settle than what they normally would. And these are for two particular reasons. Number one, for very big projects, there are, when we bid in, we find that the estimates that we put into the bid are slightly higher than the budgets made by the government. Normally they settle within 10%, and sometimes our prices are coming higher. Maybe the budgets were done 3-4 years back or at some point of time, and when we given the prices now, looking into the reality of what the situation is, the prices are coming higher. This is in spite of 2-3 competition. The authorities are generally reluctant to take a decision on this, and sometimes rebid is called for with some scope differences and such. And therefore, what should have got settled legitimately in 3 months is taking, let's say, 4 months or 5 months to settle. So we're going through that issues. Hopefully, it should get settled down at some point of time. Second is, in some of the projects that we are bidding, there are hardly any bidders. There's only a single bid. And sometimes it is us, because financially we are still where we need to be. And many of the others are probably at the present balance sheet level not even able to give a bank guarantee. Therefore, they're not bidding for the projects. And when you're a single bidder, there is a CBC guideline which says you have to bid twice, thrice, and only the third time, if you're again the lone bidder, then they can take it forward, provided you're more or less within the budgetary estimates of the project to the government authorities. So this is a new phenomenon which we had not anticipated, and that is occurring. The second issue is that there are a lot of big tickets projects which has been announced. The high-speed corridor, the river interlinking, the road expansion. In my view, due to the elections and the seemingly money that is there in the economy today, these are going a bit slow for whatever reasons. We do expect a pickup. We don't think this is in my view, this is a temporary phenomenon that has occurred. And also in road sector, especially if you see, there are a lot of disputes, arbitral disputes, concession disputes, and EPC disputes, and so on and so forth. I think government is taking a very matured view to settle some of these disputes, and therefore maybe the concentration is on that. They clean up or moving out of the situation that they are in. And when you are in that, to go on with the bids also is something which is not harmonious. But the big projects, at least that they have announced, in my view, should be taken forward. And that is taking a little more time, maybe because the loan getting negotiated or the project cost being slightly higher than what they originally anticipated. But this is a phenomenon which will get sorted out. The biggest problem for construction, this is the second part of your question, why the working capital is high, etc., is because we had an unprecedented situation this year, which just could not be anticipated, where due to pollution and such, the national capital region had a total stoppage of jobs for about 45 to 60 days. We had, due to change of government and reviews, a total review of orders that we have in Andhra Pradesh, and therefore works could not proceed there as we had originally planned. And in the Mumbai area, two of the major projects that we're doing there, due to public interest litigations and technical and legal issues, matters were at the court, they're getting sorted out. And therefore, when 3 huge areas of projects could not proceed, this is not a single project, right? There are multiple projects in all these areas. We've had some degrowth or some hit on sales and profit. Matters are getting cleared right now. The national capital area, the projects are started. Of course, there is a timeline, but okay, projects are started. Coastal Road, we have the court clearance to move ahead. And in Andhra Pradesh also, better sense is prevailing and projects are moving. I think it will get sorted out and projects will move forward. So having said that, but we have only 2.5 months left now. We lost these 9 months for the year. So what we can do for the 2.5 months, we'll try to do and try to cope up or try to catch up with the situation and try to grow within these issues that we have. Now, when projects get stopped, it is just not the project stopping. Your dues which are there get stuck up, your retention gets stuck up, your payments don't come, and that's why the working capital is showing a slight pressure. But I believe with the situation getting cleared, it will come down to what we have anticipated or what we thought it ought to be.
Hi sir, Rahul from 80 now. I just wanted to, yes sir.
Yeah.
Sir, as you said that you will be able to meet the order book guidance. So how confident are you that how you will be able to maintain that guidance, and what about the other revenue guidance and margin guidance considering the slowdown in context?
We will meet the order inflow guidance. I'm very definite we'll meet the sales guidance. I'm very confident we'll achieve the profit margin guidance.
Thank you sir.
So 2 questions,
Yeah.
both are follow-up of what you mentioned. On infra side, so Maharashtra projects which were facing a stoppage was one was
Mumbai
coastal
projects.
and the other was the metro project?
Huh?
Which were these 2 projects? One was the coastal.
National Capital Region projects.
Right.
Projects in Andhra Pradesh and the Mumbai, the coastal road,
The
Shivaji
coastal
statue
road
and
project.
such. Yeah.
And second question on your order inflow guidance, where you're maintaining your growth guidance, would a large part of this be on the back that international orders are doing good? And if you could give me a breakup of which segments are contributing to your growth in international besides hydrocarbon?
So international would be predominantly hydrocarbon, power transmission, distribution, and water. To some extent, minerals and metal too. Domestic would be across all the segments. Yeah.
And are you expecting that you would be able to meet that guidance because of international orders?
It's always been like that, right? We're not a one geography company today. Nearly 35% of our sales and backlog and orders do come from international. So we are dependent on international. So international means Middle East, to some extent Africa. Africa means not the full continent, the L as I call it, the top and the north and the eastern part of the country, of the continent. And to some extent Far East, but Far East is still very small. So it's predominantly Middle East and Africa, which is international. And domestic is of course India.
Are there any slow-moving orders?
There are. The coastal road has just started moving, so in our terminology of business or accounts, it's called slow moving.
You have moved the
statue is,
coastal road project to slow-moving?
the speed is, I need to move fast, right? It's slow moving.
Okay.
It's not a categorization. I think the only categorization you will do is projects which are shut, meaning that the client has written to us and cancelled. The rest of the project continues to remain in the order book.
So
The
is
question
there
of fast moving, slow moving, etc., is in the context of the pace of execution that we plan and what we actually achieve. Now, what was slow moving for the last 4 months now will become normal moving now. So it's very difficult to bucket them. But I don't think the order book of 3 trillion rupees that we have shown, there is anything significant that is going to upset our plans if things continue to be normal for execution.
Sir, could you tell us about your expectation from budget?
You know, how much? 102 lakh crore, right? So it will be very useful if some 20 lakh crore gets spent on the infrastructure side, because it's supposed to be over 5-year period. So what we expect, and on a serious note, I don't think budget will solve all the problem. I think budget will only address how the government is going to deal with it. It's an approach paper. All of us know that the government, the biggest constraint today we have in the system is funding. The government does not have enough resources to be able to meet its plan. It's not scaling down its plan, but it's struggling to figure out a way to meet this. So the budget maybe will give some indication of how the government is thinking about approaching this plan. Maybe the biggest lead indicator would be some slippages in fiscal, and permitted to be so, because I think in the larger interest of economic growth, maybe the financial responsibility mandate that they cast upon themselves can get a little more flexible in implementation. So that could be one. The other indicator could be how much government is going to borrow, which will have there's a lot of liquidity globally, so it's not as though money is short. It is just that the right causes need to come up and the credit flow has to increase. So government borrowing will also be an indicator. So So I don't think budget is, it'll give some idea about how the next 12 months will plan out, but I don't think it will solve all our problems.
It's an enabler. We have to look at it from that point of view.
Yes, Ashwini here from Bloomberg Queen. Could you please tell us about your revenue guidance? Will you be maintaining it 12 to 15%? In the first 9 months, we have seen a growth of just 10%. So how
Yeah.
confident are you of
See,
maintaining
if you
it?
look at last year, and you look at any period in prior, our fourth quarter has been always the biggest quarter because lot of effort happens in the fourth quarter. That's how the system of our client as well as our own system hence is geared. The asking rate is not anything dramatically different from last year, fourth quarter, if you do the math. So I think there's reasonable expectation that we should be able to keep pace. And you have our MD CEO's confirmation that he intends to be there. So we will be there.
See, bulk of the governments have this budget, right? And they have to exhaust the allocated money, otherwise it goes back. And therefore, there's also push from the client side or the consultant side to ensure that all hurdles towards progress is sort of made good so that we can achieve maximum possible. And within our system also, we get orders predominantly in Q4, and much of them mature in the Q4 of the next year. And therefore, the big ticket purchases of large value items, etc., are done in Q4, and thereby that's the quarter then we have the maximum sales. So that's how it works. And we also try to catch up as much as possible before the monsoon, because Q1, Q2 is always little slow, and therefore we try to maximize it so that we can make up for that, and that's the way it works.
And we have given a band, as you know. So when we say we will meet the guidance, we expect to be in the band, somewhere in the band. Very difficult to be precise about these estimations.
Can you give us an outlook on the defense business? I mean, at a macro level, are things moving now? And also, for L&T in particular, you are in race for a mega submarine project. So just wanted to understand what kind of timeline should we be expecting from this stage onwards?
See, as I said, it's a fascinatingly interesting startup business, right? So we are the largest private sector defense player, both on regular defense as well as our shipbuilding activity put together. Now, the point in defense, as I explained many times before, is the following. Any equipment orders to be placed have to go through, beyond the pre-qualification technical requirements, vigorous tests in the various parts of the country, because we are not rich and therefore we cannot afford to buy different types of equipments for different climates. What is prevalent in Rajasthan has to work in Jammu and Kashmir, has to work in Ladakh, has to work in Assam. And therefore, these equipments go through extensive trials. This is the cost. You can call it, we don't call it delays, it is due to the nature of the procurement process itself, and that's what takes time. Now, in this circumstances, when you go through, there are lots of trials and tribulations that take place, and finally you get qualified to move forward. So what we have is a business which is technically very advanced, which is very good, and maybe it's the largest private sector in India. But having said that, we need to have the patience to take it forward. So we do see good prospects in terms of making the missile components. We do our K9 Vajra program, the artillery gun is going well. Shipbuilding, recently there's been a spurt of offers that have come in, RFQs that have come in. We have bid for some of these projects. Hopefully we are successful. So one constantly remains positive on the sector, but one has to be circumspect to the fact that these takes time. One should not expect big growth and such, but it's a steady business, reasonably profitable. That's the way I'd like to put it.
And in terms of submarine orders, is there, given the movement that has happened, what kind of visibility do we have?
I think it's too early. The government has, by all accounts from the newspapers and such, has decided that two of the companies, one public sector and Larsen Toubro, would be shortlisted. The foreign vendor also, the foreign vendors have also been, the technical providers have also been shortlisted. So we need to now see how this movement takes forward. They have to give us the details, and then we have to look into what it is and see how to take it forward. We will do it, but it will take another 2 years for it to fructify. It's not something which is going to happen tomorrow. This is a very, very technology-intensive, costly program, and one has to have the intensity and the patience to go through it.
Also, in terms of the power, power has done well in terms of orders, but are these the orders that will just keep the order book ticking, and what is the utilization right now?
See, okay, very complex question. I'll try to answer. Power, this is coal-fired, right? So we've been lucky this year that we won Buxar and Kurja boiler. We won fair amount of FGDs. I can't name the projects as you clearly know, but there are 3 or 4 more major EPC tenders which are up for bidding in a short while. But this will happen next year. It won't happen before Q4. It will happen sometime next year, because these are fairly big bids. Now, one has to be positive that we will make our way forward in some of this. As we see today, the boiler shop has got 2.5 years of backlog, and turbine has also got nearly 2 years of work, turbine shop. So we are fairly well occupied right now. But that doesn't mean anything, because the shops can, at the best, make about 4,000 megawatts per year. We are not up to that right now. So we have spare capacity. So we are making further bids, and let us hope for positivity there. That is the first part. Second part, as you know, coal-fired after the Paris Accord, etc., has got some green, non-green meaning to it. So there is a fair amount of advanced technologies getting into the coal-fired plant to make it green. The FGDs, various other technologies getting into it too, and even modernization of some of the old power plants, getting it to the latest emission standards, etc., are going on. So there are prospects of doing some of these orders even further as we move on. At the end of the day, coal is not the brightest word in the world today. So the prospects may not be plenty, but for what it is, we'll be geared up, and we'll see how to take the business forward. We'll keep reviewing it constantly. Yeah.
Hi, sir. Anvesha, Financial Express here. Mr. Raman mentioned that sub 5% growth is a challenging environment. Could you elaborate a little bit on the macroeconomic challenges that L&T will face going forward, and if the government, if at all, can do something to alleviate these challenges?
Complex question, Isha. I'll ask Shankar Raman only to answer that.
Because he attributed the question to me.
Yeah.
See, I think a couple of things which are encouraging is the economic agenda is coming to the front burner from the back burner. For the first time in this current year, there have been a lot of political distractions, and hence it was not considered appropriate really to spend a lot of time. Today the industry consultations have been extensive at various levels in the government, and I think there is seriousness to revival. What is ailing us is very soft consumption. No jobs that are getting created to boost consumption. So all discretionary spends are put on hold. Investment classes are changing because A, the job security is in question, and B is such of those who are employed are no more into asset classes that originally they were in. So real estate is a classic example. And the third thing is, I think the trade barriers, etc., that is happening all around us globally, are creating opportunities for countries like us, provided we are willing to encash it. And this will be a window which could disappear. So I think government today is seized of the fact that the economy needs to move forward, growth has to come back. And if investments were to happen, it's important that the consumption needs to happen, only then the investments will happen. It's a bit of an enigma as to why private sector industry is waiting and how long they will wait. But government at the moment should be focusing on, and I think that's what they're doing, in trying to push their spend. It was initially through PSUs, but the state and the center in terms of distribution has been fairly even. In fact, much of our jobs have been also on account of state spending. The fiscal discipline that is required in state utilities is something that is bothering everybody concerned. Just for example, if the state electricity boards were to get more efficient, they will arrest leakages. If the system of GST settles down, and I think it is still work in progress, it's coming in the way of the state center sharing. And the big revenue chunk would be from this sharing as well. So I think there are some structural issues that the government needs to deal with, and that will automatically lead to investment consumption cycle. We do believe in a year and a half from now, this cycle will reverse, because it does take that long for things to fall in place. But we take heart from the fact that the public sector bids and the government programs are still throwing up bids, and we are participating. We're not really slowed down participating in those bids, and that's what gives us the hope. Lastly, multilaterals have a lot of developmental budgets available for spending. You've seen Japanese credit coming in, and there are a few other ECAs willing to invest in India. We've also had statistics where the FDIs have been one of the higher numbers as compared to the past few years. So there are people willing to take call on India. We need to create an environment which will make them feel comfortable, lending as well as investing. I think if government can address some of these things and industry can sort of respond by moving forward, maybe then if both the hands clap, there could be noise. So.
Basically, you have to see from the results, instead of looking at us quarter to quarter, which is difficult from a construction or a manufacturing company point of view, or an EPC company point of view, look at it from a 9-month point of view. 11% growth in orders, 10% growth in sales, and 16% growth in PAT is what you have to carry the good message.
So one question, I mean, this is regards to the Andhra projects. I mean, the government has been reviewing the projects after the change in the government, with the new government coming in. What's the status, sir? I mean, has the review been over, or what's the message that you're getting from the government?
So the review is ongoing. I think from our point of view, it's been positive that we have done what we can, and some of our projects are at 90% stage, some of our projects are 50% stage, and some of it due to land, etc., has not even started. A few of it is there like that. Now, I think the concept there was whether to have the capital at Amravati or at Vizag or at Kurnool, and they have decided to have 3 capitals. Amravati would be the legislative capital, Vizag would be the executive capital, and Kurnool would be the legal capital. It's a new way of thinking about how to develop the state. It's a very interesting concept from my point of view. It's an idea to develop 3. Rather not, Vizag is of course well developed, but develop 2 other parts of the state which is a new state, right? Andhra alone, it was earlier Andhra Pradesh, including Telangana area. So it's a new way to look at it. So in my view, I look at it as a great opportunity going forward. Of course, the state has got to find funding, money, etc., but I suppose they will do it in going forward. It's also a rich area where the Krishna river flows, where the Kaveri flows, and there's a very fertile soil. It's a fairly rich area. I guess they will know how to generate the cash, and if they do that, that's a good way to go forward. So yes, we have had this problem of not moving the jobs as of date due to the review, but I think the process is coming to a positive conclusion. We hope to move it in another 15-30 days, and once that is done, we look forward to further growth in other parts of Andhra Pradesh. Yes.
Mr. Raman Dwani from Bloomberg News. Just wanted to check on road projects. I mean, do you see any strong revival now? I mean, almost for a year there has been really, really slow ordering. So, I mean, awarding basically of road projects.
No, I think it has taken a pause. I think we've had fairly brisk ordering in the past. So, in comparison, it definitely has slowed down. There's also a mix-up in thinking about what is the right model to get these projects going. Earlier, mind was very uncluttered and clear. It was EPC. Then came the BOT. Then came the HAM. Then came the TOT. So now I think the government is figuring out which is the right way in which we could find resources to be able to do the EPC. I'm very confident EPC projects will come back. The government needs to solve the problem of funding. NHA obviously is stuck between rock and a hard place in terms of finding money to do new projects and finding money to settle claims. They have to get their act together. So minute they are able to enable the funding through the mechanism of TOT, which couple of bids have generated encouraging response for them. I expect them, at least if not in the remaining 2 months in the year, but into the next year, to do a couple of more TOTs, generate resources and order out EPC. So I expect next year to be a fairly good year as compared to the current year.
What pipeline?
Tender pipeline. There are different types of roads that we talk about. When we talk about roads, there are expressways and there are corridors which are state ways, etc. We do think that the expressways will have to gather pace. And currently there are a few which are under execution, implementation. But we do expect that next year we will see more opportunities.
We are not into BOT, HAM and TOT, right? So we got to depend on EPC roads, and that too greater than certain value. That we are yet to see, and therefore, in my view, that will take some time. If that comes, yes, we'll definitely look at bidding for them.
You You have the capability. Why are you not looking at BOT? I mean, if the government comes up with BOT orders next year, I mean, NHI comes.
We are actually committed to ROE, and these investments are not very ROE friendly. They generate value over long periods of time. The ideal investors for that kind of assets are pension funds, insurance companies which have long liability. An EPC company which gets judged every 90 days whether it's good, bad, ugly cannot afford to take on a 25-year asset and 30-year asset beyond a certain point. We did to some extent about 10% of our net worth at that point in time when we took that decision.
We allocated 21 roads.
We allocated. We came to 21 roads of ownership. We owned airport. We owned ports. But then in the new strategy, where we have gotten asset light and focusing more on high-tech engineering, manufacturing, construction, that portfolio doesn't fit. So it's not that we cannot find the money. It is not that we don't understand that space. Maybe we understand that space a little too well.
I just want to ask you, out of your hydrocarbon portfolio, what percentage is international? And because of this ongoing US-Iran-Iraq issue, do you foresee any impact in the coming quarter?
About 47-48% is currently what we have, but it has been roughly around 50%. The portfolio, and we have not all over the place in Middle East. We have few select spots. For example, we are fairly active in Saudi Arabia with Saudi Aramco, and I think geopolitics apart, the amount of capex that Saudi Aramco spends between $3 and $5 billion have remained more or less around that. So I think since we are one of those few people with whom long supply agreement, LSA as they call, has been signed up, I think we are at an advantage to cite these opportunities earlier than the rest. So we will continue to regardless of the geopolitics, cater to that requirement. We are also, I think, fairly good today in whatever we have done in Oman, whatever we have done in Kuwait. Some of the completions that we have done in the last 2 years have been very, very encouraging and been praised by the clients. So I think we have what it takes to be selectively viable in those markets.
So just one question. In many of your projects that you're bidding for, does the fact that the competitors don't have a strong balance sheet sort of a thing to speak of, how much of a delay are these factors also causing in the overall scheme of things?
It's the process of bidding, right? As per the guideline, you bid once, and if you're the only bidder, then they have to call for the bid again. That may be another month, and then you have to call it again, maybe another month, so it's 3 months. Okay, gentlemen, thank you. So, once again, 9 months, 11, 10 and 16. Okay, that is order inflow, sales and PA. Thank you.
You are free to quote in reverse order.